Good morning, everybody. This is Mr. Oxy coming at you live from Palm Beach in Florida. It is March the 13th. It is Sunday. March the 13th also means we're halfway through the last month of the first quarter already. And we only heard what happened in the previous quarter and fiscal year 2021 just a couple of weeks ago. And here we are. Large institutional buys over the last couple of weeks. Large institutional sells over the last couple of weeks with Carl Icahn exiting, Berkshire Hathaway just jumping in boots and all, and of course Blackrock picking up another 10, 15 million shares. So many people have asked now with Oxy at around $50, $58 or so, is now a good time to buy? Now, of course, there's no way I can answer that question, right? So I don't know anything about you. I don't know what your investment objectives are. I don't know what your earnings are. I don't know what your age is. In other words, what your timeline for investment is. I don't know what your investment objectives are and all that kind of stuff. So it's very difficult to provide someone with advice. And by the way, you don't need to tell me any of those things either, because it's not my role to advise you. It's better if you do your own due diligence and get educated about the stocks that you wish to invest in, and then take it from there. But I do want to sort of give you an overview of Oxy and where we are. And then you can perhaps make a better informed decision as to whether you want to buy Occidental or not at around $58, which was the closing price on Friday. Now, I'm not going to go into detail on every screen here, but there are a couple of things we can note at a glance here. It's trading at its or near its all-time high for the 52-week range. And sorry, I shouldn't have said all time, because there are people who still own Oxy shares that they purchased, more than 3 years ago for perhaps 70, 80 bucks or thereabouts. So yeah, 52-week high, around $58. It's close. A couple of things that are interesting here, just on this snapshot. The earnings per share is positive. That's a good thing. The PE ratio edging up to 28. Now, I've shared this with you before. As a general rule, if I want to get into a new position, in other words, not an existing position, but a new position, the PE ratio gives you a quick snapshot as an indication as to whether the stock is expensive or not. Now, as a general rule, the S&P 500 average is around 15. So you can say theoretically, or hypothetically, anything that's below 15 is cheap, and everything that is above 15 is expensive. So if you only use the PE ratio as a benchmark or indicator as to whether you should buy a stock or not, which wouldn't be the right thing to do, then Oxy at the current price of about $58 seems expensive. If you're buying it for a dividend, you can do better elsewhere. So, I mean, you could buy the super majors like Exxon, Chevron, etc. if you're looking for the dividend specifically. And then you might forego a little bit of stock appreciation in terms of the stock price from a growth point of view, in exchange for a more consistent and a larger dividend. But other things come into play there as well, because Oxy will probably increase the dividend as they go along and as they raise more free cash flow. And in addition to that, obviously, they announced a share buyback of about $3 billion. Let's look at some of the highlights. For some people, it might be lowlights, but for me, it's certainly a highlights reel. So let's take a look at sort of where we are. Historic growth over the past 5 years. This is not necessarily a good picture. Obviously, the dividend was cut to a penny a quarter just a couple of years ago. Revenue growth has been meh. Institutional holding shares, 1,060 large buyers of Occidental Petroleum. And currently, the institutional holding is around 72%, very, very high. Institutions generally buy in and hold for quite a long time. Even activist investor Carl Icahn was in the position with Oxy for about 3 years. And now that he's exited, he still owns about 18 million warrants. If we look at a quick snapshot of the financials, I'm not going to go into the actual financial statements. The balance sheet, I drew a little dotted green line here, kind of shows you where Oxy was in terms of cash and short-term investments as recently as 2018, 2019, leading up to the acquisition of Anadarko. Nice uptrend there. They were sitting on a lot of cash and short-term investments, even though they had to borrow money from Berkshire Hathaway. to execute the deal with Anadarko. 2020, we all know what happened there. And now it's kind of edging its way back up there again in terms of cash and short-term investments. But you can see at a glance, it's not where it was before. So there's still some growth that needs to come into the picture there to make the picture look a little better than what it looks today. The income statement, this is slightly different. Very, very positive for Occidental. Total revenue right now, arguably the highest it's been in many years. And one of the reasons for that is the high price of the commodity. So this has less to do with, no disrespect to Oxy's management, who have done a really good job, but this has less to do with their management, cost-cutting, balance sheet repair, etc., and more to do with the high price of the commodities and products that they sell. If we look at total cash from operations from a cash flow point of view, this is a pretty picture. Oxy is in a good position there, and they are printing money with the prices where they are right now. So if we look at the balance sheet specifically, so here we're looking at cash and short-term investments. I just talked about that a minute ago. We look at debt. It's come down a little, right? So I say that with some reservation because they've done a good job on balance sheet repair, but we are not even close to where we actually came from. Look at 2017-18, prior to that Anadarko acquisition, and where we are today. So this number here, which is currently sitting at below 30 billion, arguably should be down here in the $20 billion range for it to be respectable and perhaps achieve investment grade. They've done a good job. And on this particular point, you can kind of have a bit of a philosophical debate and say, should they be doing share buybacks? Should they be increasing the dividend? Or should they rather focus on debt repayment and managing their operational costs? You know, I think overall they've tried to do a little bit of everything, and they've done a pretty good job at doing it. So I'm not going to be critical in that regard at all. To me, the picture is positive. It's looking better and it's looking good. On total equity, you can see the hit that we took as investors. You know, 2019 was a big year in terms of equity, but since then, many of those assets have been written down, depreciated, and disposed of at prices that were less than what they were initially indicated as value on the balance sheet. And you can see over the last 2 years now, with if you compare 2020 to 21, there's a slight uptick in equity, which will also improve as they pay off more debt. And by the way, as you pay off more debt, you also end up paying less interest, which means you have more cash. If we look at the income statement comparatively, total revenue looking really good. This picture is pretty good for Occidental. 2021, certainly for the past 5 years, bottom left of the screen, revenue they're generating now is higher than what they have been generating for the past 5 years. And with the Anadarko assets included in the mix, you could say it should even be greater than that, but that's a good picture. Total operating income, obviously a huge swing. 2020 was a massive hit. And it's just unfortunate from a timing point of view that the 2020 pandemic hit right after Occidental made that heavy debt acquisition of Anadarko. Total net income, bottom right of the screen, is looking slightly better, but as you can see, not that great. In 2018, the total net income was actually almost double what it is today. So Oxy still, from that point of view, has a ways to go. And the reason why I'm doing this, by the way, is because I'm trying to be fair and balanced. And instead of going rah, buy Oxy. Oxy's on the up, and soon it's going to be trading at $100 a share. I'd rather give you good information that you can use in order to make a good decision that fits your investment thesis best. Valuation analysis, we look at this, and because Oxy has positive earnings, the PE and price to book is most appropriate, together are most appropriate. Oxy, from a price to earnings point of view, the PE ratio higher than its peers, and the price to book higher than its peers as well. Oxy in this graph here, or this graphic, is the little gray block, and the industry average, the little black line. At the top of the page, Oxy seems expensive with a PE value of 28. I touched on that a minute ago when I showed you the snapshot of Oxy with its PE at around 28. And it's certainly above the oil and gas consumable fuels industry median of 15, which is what I said at the beginning, right? If it's less than 15, it seems cheap. If it's more than 15, it seems expensive. But that cannot be the only criteria that you use to base your investment thesis on. Profitability. Oxy converts an above median percentage of its revenues to profit. It's doing a pretty good job in that regard, outperforms the industry easily from a profitability point of view. Look at the gross margin. TTM means trailing 12 months, 60 compared to 30. And then operating profit trailing 12 months, 16 compared to negative 16. And net profit margin for the trailing 12 months, positive 10 compared to the industry's 1%. So Oxy, in terms of, again, coming back to the point of balance sheet repair, the way that they've been addressing the debt, the way that they've been generating free cash flow as a result of the very high commodity prices, is in a good position to be profitable and be phenomenally profitable, even more so for Q1 2022 than what they were in any quarter preceding. The dividend analysis is pretty much nothing to look at. We know they scrapped the dividend when they got themselves into a spot of bother to a penny per quarter. Now it's just slightly higher. But if you're looking for a dividend, then you should look elsewhere and not invest in Oxy as a sort of value investment. From a growth rate point of view, this is an interesting picture because if we look at the earnings per share, so MRQ is the most recent quarter and TTM trailing 12 months, lagging the industry quite significantly. So from an EPS point of view, even though Oxy has shown us a phenomenal turnaround in terms of results, once again, as a result of the high commodity prices. And the reason why I keep saying that is because if the price of oil, for whatever reason, were to suddenly drop or crash, this would impact Oxy negatively in a big way. So they really need to get their debt down to, as I said, sort of investment grade, maybe sort of around 20 billion ASAP while times are good. I could be completely comfortable with not earning a high dividend, and even with them not necessarily buying back more shares, if they would allocate more cash to paying off the debt and get themselves in a sort of ready state to generate more earnings per share on an ongoing basis. So most recent quarter EPS growth, pretty good, over 100%, but the industry is over 300%. And for trailing 12 months, again, over 100%, the industry average at 250%. Revenue growth for the most recent quarter, only 16%, the industry 366% averaged. Revenue growth for the trailing 12 months, much better picture, 45% compared to the industry's 75%. Remember, I'm not being anti-Oxy here. I'm just trying to give you a fair and balanced overview of Occidental. How effective is Oxy at managing these assets? So the return on equity, pretty good. Oxy 20%, the industry 18%, outperforming the industry on return on equity for the trailing 12 months. The return on assets, it's okay. The return on investment, not too good. 4% compared to the industry's almost 10%. Financial strength, well, this is the interesting picture here. This has improved dramatically. It's a significant turnaround from where we were not even a year ago, but even 9 months ago. The last 2 quarters have been good. This quarter should be particularly good too, and change this picture once more. The total debt to capital ratio is still far greater than the industry average, which is now down to 37. Not too long ago, 50-60% debt to capital was the norm. Oxy is still at 59%. The industry now down to 37. So you could say philosophically, the industry as a whole, or the sector as a whole, has done a much better job quicker than Oxy on debt repair or balance sheet repair. The difference between the two is that the industry as a sector 2 years ago didn't acquire Anadarko, but Oxy did. So there are significant changes or events that are material, which don't necessarily apply to the industry. And as I said earlier, the acquisition of Anadarko, followed by the crash as a result of the 2020 pandemic, was probably, arguably, too much to handle. So it's not a bad deal. It was just ill timing. That's all. And you can't predict the timing. It's the same as me saying I'm going to try to time the market to buy a stock. It doesn't work. right? You have to do your due diligence, analyze the stock and say, okay, this is the right thing for me to do. The quick ratio, excellent. I always say, and I've said it in many videos before, we need to see a quick ratio for the most recent quarter of 1 or above. They've hit 1. 1 simply means that their cash and cash equivalents on hand are sufficient in order to repay short-term debt, in other words, accounts payable and things like that. The interest coverage, pretty good to 13 times compared to the industry's 9. With an interest coverage ratio of 13.7 and a quick ratio of 1, Occidental should be easily comfortable to repay its debt. We know that from the last balance sheet review. What do the experts say? So I went into TD Ameritrade, where I actually pulled a snapshot from tip ranks. Oxy is ranked 10, outperform, and you can see if you go to tipranks.com, you can pull up Oxy and you can get more information about this to see what the smart people say. But it's still rated 10, outperform. And of course, we see the institutional buyers jumping in. Is it right for you or not? I don't know. You can tell me in the comments. What do the analysts predict? They say it's a moderate buy. 10 are saying buy, 5 are saying hold, and 1 is saying sell. So this actually has not changed much over the recent couple of weeks or so, despite all the activity and volatility in the market activity as it relates to Occidental with Carl Icahn and Warren Buffett, and of course Blackrock. But look at these price targets, right? There's a huge delta between the highest target, which is $75, and $34, which is obviously the one analyst that says sell. So based on the 16 sell-side analysts who offered a 12-month price target in the last 3 months, analysts predict a negative 13.3% decrease from today. So we know Oxy is at about $58 a share. So let's see what at least one of the smart guys, Dave Meets, he's from Morningstar. Let's see what he says. He says we're lowering our fair value estimate for Oxy from 47 to 47 from 49, right? So they are basically saying the fair value of Oxy is about $50. It's currently trading at 58. So now you can sort of say, okay, if I trust Dave Meets, then if I buy today at $58, today being Monday, tomorrow, if I buy at $58, I need to be prepared that it might pull back to about 50 or even below 50. Arguably, you could say if Dave Meets is correct and Oxy does pull back to about 47, maybe I should wait a bit and see if I can pick up somewhere around 40-something dollars, maybe in the high 40s. On the other hand, if you wait a bit and Dave Meets is wrong and Oxy shoots up to $80, then you're going to say, I lost the opportunity to get into Oxy at 58. And Dave Meets will simply, issue a new note and adjust his fair value estimate or target price. What's his reasoning behind it? He says the 2022 capital budget includes more inflationary pressure than we were anticipating. Now, I've talked many times before about the current environment, which is hyperinflationary. And in addition to that, the Fed said the inflation is transitory. It is not transitory. It's going to be with us for quite some time, perhaps for the entire 2022 or even beyond. This is not going to go away quickly because the oil price is not going to pull back quickly, and that impacts and affects everything, including Occidental Petroleum. So the inflationary pressure that we feel as consumers or investors, they feel multiplied by millions because they're a multi-billion-dollar corporation. Well costs have risen by about 15%. So when you do balance sheet repair and you address the debt, you're also looking at operational management and trying to manage or maintain your operational costs, but costs are going up. So well costs have risen by about 15%, which primarily reflects higher costs for steel, fuel, and labor. The magnitude of this inflation is not a surprise because we're all experiencing, right? But we are expecting the firm to offset a portion of it with ongoing efficiency gains, and updated guidance suggests management is not expecting to do so. We applaud management for the dramatic balance sheet improvements it has engineered in the past couple of years. The greater portion of equity is now embedded in the capital structure and warrants a higher cost of capital. So that's kind of the modeling that they've done. You can sort of, you can decide for yourself whether Dave is correct or not. The analyst price target, going back to tip ranks, is $50. So I just said, if you buy it at $58, never mind David Meets, this is the average. The analysts are basically saying Oxy has a $50 price target. So if you buy it at 58, you need to be prepared for it to drop by 10, 15% and go down to 50. Now, as I just said a minute ago, it might just jump up to 80, because also remember that many of these average pricing is sort of looking back over the past 3 months and don't necessarily take into consideration the activity, including Berkshire Hathaway and Blackrock, buying millions and millions of shares, regardless of the fact that Carl Icahn sold, 29 million shares. And by the way, even though he sold 20-something million shares, as I said at the beginning, he still owns 18 million warrants. So the warrants, by the way, gives him the right to buy back into Oxy. If he has 18 million warrants, he can buy 18 million shares of Occidental for $22. So who knows? He might jump back in. Let's look to the future a little bit. We see that the estimated earnings per share for the next earnings release is $1.40. That'd be pretty good, because a nice bump up from the previous quarter, where we saw, about $1.10. And then the PE ratio, based on the analyst's reduced price target, price versus earnings, then drops down to around 15 or even below, which is obviously quite a change. The next earnings date is scheduled for May the 9th. So even though we're nearly at the end of the first quarter, we're going to have to wait a couple of months from where we are today before we find out what happened in Q1 of 2022. And the analyst average price target is $50.40. So rather than me tell you whether you should buy Occidental or not, how about you tell me whether you should buy Occidental or not? I look forward to your comments. And as usual, if you like the content I prepare for you, and you are comfortable doing so, hit the subscribe button, because it helps to keep me motivated to do some more. I am still long and strong Oxy. I did share in a previous video that I took some profit off the table. By selling my most expensive shares, I've basically reduced my cost basis to nearly nothing. And therefore, I, as a person who invests for a variety of different reasons, with a primary focus at my age in terms of where I'm at in my investment career, being more preservation, cash preservation, wealth preservation, rather than growth. In other words, I like growth, but I need to protect my assets, because it is my primary source of my humble wealth. But the focus for me is preservation. So when I have an opportunity to take a profit, like Oxy presented me, I sold my most expensive shares on which I made some profit, which reduced my cost basis and effectively left me with several thousand shares of Occidental Petroleum, which is borderline playing with the house's money. So for me, that's a good place to be. Would I buy more now? I'm not certain I would buy some right away. If Oxy were to pull back below 50, I might look at adding to my existing position. On the other hand, if you were prepared to get into Oxy and maybe hold it for medium term, 3 to 5 years or so, and you start a new position today. So if you initiate a new position today, then $58 might be a respectable and decent price for you to start opening a position with in Occidental. Let me know what you think. I look forward to your comments, and as usual, thank you for watching. Bye-bye.